Today I'm going to go over once again the potential for maybe a bubble phase in stocks. Um, see a lot of people nervous about getting caught at the top, which is ridiculous. All you have to do is put a stop underneath the previous daily cycle low to prevent yourself from ever getting caught when a bubble pops. You could even put a stop underneath um, this intermediate cycle low. If we were to make a lower intermediate cycle low, that would be a big warning sign that we're not ready for the bubble yet. So this irrational fear that somehow they're going to get caught in a bubble and they're going to lose 50, 60, 70% of their account is just foolish. There are very easy ways to protect against that. What most people I guess, are afraid to do is to imagine big. As I pointed out in some of my previous videos, it's not unusual for a bubble to tack on 80, 90, 100% in the last uh, 3 to 6 months during that final melt up parabolic phase. However, as I've also explained, the market tends to get more volatile um, when you get into that last phase. So there are profit-taking events where traders, especially professional institutional traders, are starting to get nervous. And then when you start to get some selling, everybody heads for the door at the same time, and so you get these big, nasty, scary moves down. The As a matter of fact, let me backtrack this chart here, and I'll show you. All right, this is the 2000 tech bubble. And here's what I was talking about. And this kind of really launched in October of 99. And it went from 26,000 to over 5,000. So almost 100%. It did that in about 5, 6 months. But um, as this gets more mature and as price starts to stretch further and further above the long-term mean, traders start to get nervous. Professional traders do. Um, Retail, novice type traders, they become more and more confident, and they are what it pushed these bubbles. They see their neighbors getting rich, without doing anything, and they want to get rich, and so they're willing to hit any kind of an ask. Huge bid ask spreads. They're willing to hit them because they're afraid of missing out on the move. So that's what drives a bubble. But as I said, during the middle and latter stages of the true parabolic phase, things get really volatile. You can see even during this kind of a basing phase here, things were extremely volatile. This moved down into this was an intermediate cycle low, but it went from 28, almost 29, down to 20. We'll just round it off, call it 24. That's a 17% um, pull drawdown. Compare that to what's happening right now, and I'm seeing traders already very nervous about the stock market, and the Nasdaq's only dropped 7%. This drawdown here was 17%, and all it did was build the fuel for another um, intermediate cycle, and then a launch into that final bubble phase. During the middle of the bubble, both of these were 12, and I think this was 14%. This only took 5 days to shave off 12%, and this only took about 6 or 7 days to shave off 14%. In real time, that looked like the market had topped. But as we now know, there was still a long ways to go yet before that bubble did top. So I think that's the mistake. Well, there's two mistakes that traders make. For one, they have this irrational fear that they're going to get caught when the bubble pops, and you don't really need to. Like here's a perfect example. This is how you could have got out of this crash. We dropped down into a daily cycle low. We bounced, made the double top, was not able to make a higher high. Once price went back below this low right here, that's your signal that you're out. You're done. And when you see something that stretches this far above the 200-day moving average, it's a bubble. So um, when you get any kind of signal that a daily cycle or a cycle has failed and left translated, then you're done. Um, yes, I think this was 60% above the 200-day moving average. So that there's no reason to have this irrational fear that you're going to get caught in a bubble and you're going to lose everything. And then the other huge mistake I think that traders make is that they are afraid, because they're afraid of getting caught in a bubble. They're afraid to give the market the benefit of the doubt and give it a shot. If it doesn't work out, if you get stopped out, whatever, so be it. But excuse me. But nobody's going to ring the bell for you and tell you that, hey, the bubble's starting. You got to get in and you got to hang on. So anytime that it looks like it might be starting, you have to give it the benefit of the doubt and trade it as such. Now I've gone over, and in one of my previous videos I noted that I made a webinar to teach people how to trade leveraged, how to trade it correctly, so that you're not risking blowing up your account. That webinar is still going to be available for a few more days before anybody that is a member or wants to sign up to the SMT. Then you can purchase that webinar if you want to learn how to use leverage correctly, so that you don't blow up your account. Because if it doesn't turn out to be the bubble and it comes back down, and you get stopped out, then the leverage will backfire. So there's a right way and a wrong way to use leverage. But going back to this chart, you have to expect that this kind of crazy volatility is going to happen. When we get into a bubble phase, and nobody's going to ring the bell for you right here to tell you it's starting. So anytime it looks like it might be starting, you got to give it the benefit of the doubt, and you got to think big. So during the move out of this intermediate cycle low, I was giving this the benefit of the doubt. Maybe this is the start of the bubble. Now with a little more um, evidence, this looks more like a volatility event than it does the start of a bubble. But a volatility event is what sets the stage for the bubble. So right now, this is only down 7%. As I said, um, before the bubble took off in '99, we had a 17% correction. Um, during the bubble phase, we had a 12 and a 14% correction. So nothing terribly unusual is happening right here. So let me show you how I traded this so far and what I'm doing at the moment. All right, so these are my trades since the end of September. I started off trading oil because oil was trending pretty nicely, and I started off with about $12,000. I had had a losing trade before that. I was up to about 120,000 and had a losing trade, and knocked me back down to 12. So anyway, I started trading oil, made some gains, and then I'm pressing my bets, but my risk at this point is only $12,000. That's the most I can lose. I can lose my profits, but I'm not going to lose more than $12,000, and $12,000 is completely meaningless to me. I could lose that many multiple times and then try again. And that is the essence of trading smart with leverage is you start with something small that you can afford to lose, and you try and string together a series of winning trades. So I had several winning trades in USO, and then it started to look like the stock market was finally going to put in an intermediate cycle low. And I want to trade those intermediate cycle lows in the stock market because they tend to kind of rocket launch out of those intermediate lows, and that's where you can make money in call options. And so I converted from trading USO oil to trading the QQQ. And you can see I At that point, I had almost doubled my account with USO, and then I started to trade the Qs. Got with this trade, got it up to 34, doubled it again at 67, 111, and then took a loss, but not a big one, a small loss, about 10% on the account. Um, got back in for another quick trade in USO, and then back to the QQQ. And so at my last closing trade, with never risking more than $12,000, I am risking my profits, but my original investment of 12,000 is all I'm risking. I'm playing with the house's money now. So as of the last closing trade, I'm up about 1,000% on this portfolio. Now, my my next trade, we were getting close to a daily cycle low, but who knows whether or not the cycles are going to be uniform during a bubble. So I didn't really want to exit, even though I knew we were getting close to a daily cycle low. Sometimes they can be very mild. So I wanted to stay in the trade, but I did want to give myself more time, just in case something happened like what is happening right now, in case we get a deeper correction than what I was expecting. So I wanted to keep my leverage high, so I went several strikes out of the money. At the time, I think this was about 5 strikes out of the money. But I went all the way out to February to give myself plenty of time in case the daily cycle low took longer or went deeper than I was expecting, which it is. So this was a good call, and I kind of explained how to anticipate these kind of adjustments in the webinar. So we'll see. I may give back all of these profits if the market doesn't recover and get back above 400, and I needed to go above 415,000. But I'm going to give it the benefit of the doubt because with the setup is there that maybe we could be starting the bubble, and if we are starting the bubble phase, then this trade is going to recover. It's probably going to make another 100 or 200%, and my 100,000 that I'm at right now will turn into 1 or 2 or 3 million if we were to get a bubble similar to what the Nasdaq did in '99 and 2000. I don't know if that's going to happen, but I'm certainly going to give it the benefit of the doubt and trade it as if it is, because nobody's going to ring a bell for me telling me that the bubble started. And if not, then this trade will be a losing trade, and I'll have to start over again. But I'm not risking anything that I'm not completely able to lose, which again was that initial stake was about $12,000. Now I'm just risking the house money. I'm willing to lose the house money, and if I lose that, then I'll start over again. I'll try again, because eventually there is going to be a bubble phase, and when that happens, there's going to be a lot of money to be made. But you can't make it if you can't imagine that a bubble will happen at some point, and trade each potential setup as if it is. All right, so that webinar is available, I think, till either the 6th or 7th. So you got a couple, 2-3 days left if you want to join the SMT, and if you want to purchase that webinar where I go into a lot more depth on how to use leverage correctly so that you don't blow up your portfolio trying to catch the bubble, which may or may not be ready to happen yet.